All right, hello and welcome back, everyone. Today we're going to be doing a basic three-statement model. It'll be a 5-year projection, just kind of to dip people's toes or those who don't have a lot of experience with what three-statement modeling looks like. And the key is we're going to be building out a true connected three-statement model without an equity plug. So the balance sheet will automatically balance as a result of how we're projecting, as opposed to just plugging equity to make it work. We have for Widget Corp here. We have our LTM financials. The assumption is going to be that things are going to stay the same either as a percentage or dollar amount, or either as a percentage of revenue or as a dollar amount moving forward. We have kind of our other assumptions about our capex being 10%, and then we also have kind of our opening balance sheet. And so first we're going to model out, I guess, our kind of year zero income statement and balance sheet. Then we'll project out the income statement, project out the balance sheet, and then reconcile everything on the cash flow statement. So by the end, we should have a fully functioning three-statement model that you could use and kind of take to extrapolate or apply broader to like securities or companies that you need to in the future. So starting off, we're going to go into our spreadsheet. As always, gonna put in our elevator drops just that way we can navigate between the three statements a little bit easier. Gonna model out or expand out a couple of columns that we're going to use for projections, and then I'll put in a basic formatting um, for the entirety of the sheet. So I'm just selecting everything here and then putting in the basic formatting. Essentially what this is saying is if something's in the thousands, put in a comma, do it with the one decimal place, and then this last part is just to line it up. This is saying the second part so this is positive numbers over here, formatted like this. This second part is saying for negative numbers, format them in parentheses with a comma for thousands. And then this last part is if something's a zero, just put it as a hyphen. So now that we have our base formatting in, I'm also going to take off the grid line, so Alt WVG, and then we'll put in some basic information after changing the font. So we'll do Arial, and then we'll do size 10. So we'll start with our company name, which is Widget Corp. Widget Corp. So we can jump into our income statement. I'll highlight this over, put this in white, so it pops a little bit better, and then we'll put an X here so we can navigate up and down. So first thing that I'm going to do is I'm going to start with the year. So assuming that this is year 0, or the year that we're currently in is year 0, just add 1 to get out to 5 years, because we're going to be projecting out to 5 years. Then we'll put in formatting here, year 0, so everything's situated like that. There we go. Now we have our year situated. We can start building out the actual items. So we'll start with our revenue. Bold this. Then we're going to subtract out our COGS, cost of goods sold. If we go back to the prop, we can see that we have revenue, COGS, gross profit. For operating expenses, we're going to have SG&A and R&D. That gets us to our EBITDA. We're just going to have basic D&A of 50 with an EBIT of 250, $50 in interest expense, which will get us to an EBT of 20, and then we have a 25% tax rate. So we'll have our COGS. Our revenue less our COGS is going to be our gross profit. Highlight this, bold it, put in a border up above. Then we're going to take away our SG&A, our R&D. Those are the only operating expenses we have, so that'll get us to our EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Then we're going to take away our D&A, which will get us to our EBIT. Lastly, we have our interest expense, which gets us to our EBT, or earnings before taxes. And then the very last thing we have to take away is our income taxes, which will get us to our net income, which will be the first line item on our cash flow statement. Now that we have these kind of situated, what we're going to do is we're going to put in our year 1 historicals. So we have revenue of 1,000, then we have COGS of 500, meaning our gross profit is 500. Then we have SG&A and R&D of 100 respectively each, which means that we're going to have an EBITDA of 300. Then our EBITDA of 300 less the $50 in D&A gets us to $250 of EBIT. Then we have $50 in interest expense, which gets us to $200 of EBT. And then it doesn't tell us what our taxes are for this first year, but we can back into it. And there's typically two schools of thoughts as I'm typing out these operating assumptions in terms of how you should approach inputting assumptions. So the way that I'll be doing it here is with all the assumptions at the bottom. So we'll have our revenue growth rate, we'll have our percent COGS, and when something's percent, the way you can think about this is just COGS as a percent of revenue is really what's happening. But I'll just type it out as percent COGS. Then we'll have our percent SG&A, percent R&D, percent DNA. We'll have our interest expense, which we're going to assume is going to remain the same throughout the period. Then we'll have our tax rate, and that'll be enough for us to finish out our model. So for our revenue growth rate, we're going to assume 10% moving forward, and I'll assume by setting this equals and then projecting it out like this, that is going to be 10% throughout the entirety of the projection period. With every other historical, we're going to assume that it stays the same either as a dollar amount or as a percentage of revenue. So typically for COGS, what you'll see is you'll do COGS as a percentage of revenue. So we'll do our COGS divided by our revenue to get our percent cost of goods sold. So it's 50, and then we're going to assume that it's going to remain 50 throughout the entirety of the period. I'll just highlight forward using Shift and the arrow keys, and then press Control R. For the SG&A and the R&D, we're going to do the exact same thing. Our SG&A divided by our revenue, and then our R&D divided by our revenue as well. And so these both are going to be 10%. And we'll assume that this is going to stay the same moving forward. Lastly, we'll have our DNA, which we're going to do as a percentage of revenue. So it'll be DNA divided by revenue, just like that. And you can set up kind of more complicated schedules, which we can maybe do in a later video. But for now, we're just going to assume everything remains consistent as a percent of revenue. And then we'll assume that our interest expense is going to stay the same as a dollar amount. So it'll be 50 every year instead of as a percentage, because we're assuming no repayment on kind of the existing debt, and that our interest rate or our interest is, or our debt, excuse me, is long enough term that it won't change throughout the entirety of the period. And so our dollar amount for interest expense should stay the same. And then we have a 25% tax rate, which was given to us at the very end of our situation. The other thing that I'll include in here, and you can do it elsewhere, but I like to do it here so I don't forget, is our percentage of CapEx. And so typically I'll do this directly under the DNA, so that way I remember when I'm going to my cash flow statement to look up towards the DNA on the income statement to project out my kind of CapEx. So CapEx is given to us as 10% of revenue, and that'll stay the same throughout the period. Okay, now that we have kind of our base historical year outline, we can start projecting things forward. So we'll start with our year one. And to project out the revenue, you'll do the previous period times 1 plus your revenue growth rate. Then I'm going to select this forward and paste it. For our COGS, it's going to be a percentage of our revenue. So I'll multiply out our COGS percentage, or I guess our COGS as a percentage of revenue. That'll give us 550. I'll project that forward. For our gross profit, it's just going to be the sum of our COGS and our revenue, just like that. Our SG&A, it's going to be the 10% times our revenue. Project that forward. Our R&D, similar situation, that 10% times the 1100 we have now, which gets us our EBITDA figure. So it's just going to be the sum of our gross profit less our R&D less our SG&A. So we have 330 in year one. For our DNA, it's going to be a percentage of our revenue. So here it'll be that 5% times our revenue. Paste that equation forward. Our EBIT is just going to be our EBITDA less our DNA, which will get us to 275 in year one, just like that. And for all of these, I'm just taking the sum of what's above. And so the reason that I have these and put it as negative is so that way I can take the sum instead of if I did this minus my SG&A minus my R&D. It's a lot more intensive in terms of I have to type in each individual cell. But by putting everything in as negatives, I can just do the sum of these three, and it's a lot quicker. So that's why I'm doing it like that. For our interest expense, we're going to assume that it stays at that 50. So we'll just link to that, link down to it. There you go. And then the sum of our EBIT and our interest expense is going to get us to our earnings before taxes. Then we'll take our earnings before taxes and we'll multiply it by our tax rate to give us what our income taxes are going to be for the period. So in this case, we'll have 56 million in income taxes in year one. I'll just paste that equation forward, and I'm just highlighting. So I'll do that. So I'm just selecting where I've already put in the equation. I'm going to shift click over with the arrow. So shift and then right arrow, and then press Control R. Then for my net income, it's just going to be the sum of my income taxes and my EBT. So there we go. We have the income statement completely projected out. I also forgot to put in here that this is in millions, just like that. And there you go. You have our income statement projected out. The last thing that I kind of like to do in the income statement is do some basic formatting. So I'll put in here for revenue, a $sign, and then also for the net income, a $sign, kind of these top and bottom line items. We'll put it in. One other thing that would be good to do would be to format these in blue. I use a specific blue, but it's really kind of just up to you. But format these in blue to show that they're hard-coded, whereas all the numbers in black are going to be the result of formulas. This is actually hard coded too up here. So do that, just like that, and there we go. So we have our income statement situated. Now we can move on to our balance sheet and projecting out the historicals. So we'll do our balance sheet, and this is also going to be in millions, just like that. And so we'll first have our assets, bold and underline. And so here we're going to go back and forth and look at kind of what all of our assets are. So we'll have cash, AR, inventory, and prepaid expenses. Then we'll have PP&E and goodwill. PP&E, PP&E, not PP&D, and then goodwill lastly. So this will get us to our total assets, which is just going to be the sum of all of these. I'll put in some kind of basic formatting. And now we can go in. I'm actually going to paste up to our year, just like this. I'll paste over the formatting just so we know what year we're in here. There we go. And so all I did there, just to talk you through it, is equals our year from up here, and then I paste it over for year 1 through 5. Then I'm going to press Shift Spacebar to select the entire row. Press Control C, go back down to here, Shift Spacebar to select this whole row, Alt ES, and then T for formats. And that's how you kind of do that kind of quickly to have your years in for each year. But now we can get started on year 0. So our cash is going to be 50 with AR of 20. Then we have 10 in inventory and 10 in prepaid expenses, 100 in PP&E, and 20 goodwill. 120, meaning our total asset balance for year 1 is going to be 210. Then after we're done with our assets, we can go to our liabilities, just like that. And so here we have AP, accrued liabilities, deferred revenue, and debt. So AP, accrued liabilities, deferred revenue, and then debt. And so you can have kind of a distinction between your long-term assets or your current assets and your long-term assets and your current liabilities and your long-term liabilities. But here I'm just going to group everything together because it's not that complicated of a model. Next thing, we'll just put in our historicals. 25, 15, 10, and then 100 of debt. Do alt equals, meaning we have 150 in total liabilities. And then the last thing we're going to have here is our equity component. And so here, all we have is common stock, and then some retained earnings. And I'm going to paste this down just like I showed you earlier, and reformat it for equity. And so the dollar amounts for this is 40 million in common stock and then 20 million in retained earnings. It's the last thing that I'll build in here is called a check. And so, the basic rule of accounting is that assets have to be equal to liabilities plus equity. And so here we'll just do a check where is our assets minus our liabilities plus our equity equals 0. Okay, it does. So I know that the balance sheet is balancing, and that's okay. The other thing I'll do before we start projecting out some of these line items is I want to highlight these all in blue because they're hard coded, just like we talked about up above. So there we go. Now we're ready to project out our balance sheet line items. Starting with cash, we're actually going to have to come back to this because our cash balance is going to be equal to our beginning cash. I'll actually type it over here. Our beginning cash plus our net changing cash, which is going to come off of the cash flow statements. We're not going to be able to fill this out quite yet. For our working capital line items, we're going to put down here, I'll call this our working capital assumptions. So we'll start with our AR, we have our inventory, we have our prepaid expenses, then we'll have our AP, our accrued liabilities, and then our deferred revenue. So these are all of our working capital line items, and I'll talk through really quick how we're going to project each of them out. So with our AR, we're going to use receivable days, which as an equation is just our AR divided by our revenue times 365. And so what we'll do with this is we'll first calculate our receivable days in year 0, and then our assumption is going to be that it'll stay the same moving forward. So our year 0 receivable days are going to be equal to our AR divided by our revenue of 1,000 times 365. So that would be 7.3. And so we're going to assume that it's going to stay as 7.3 moving forward. I'll put a little note in here. I'll just say straight lined receivable days. That way I know what I use to project it. And so if I think about it, if my receivable days are equal to my AR divided by my revenue times 365, I can kind of rework this equation to calculate back into what my ending AR balance should be. So if this is equal to receivable days. That means that I can back into my AR, which is going to be equal to my receivable days divided by 365 times my revenue. So I'm just kind of reworking the equation to calculate it out. So I'll show you what that looks like up here when we calculate it. So we're going to take our receivable days, which we calculated previously and assumed it's going to be straight line, divided by 365, multiplied by our revenue, and that's going to be our ending AR balance. And so we can project this forward, paste that equation forward, and you can kind of sense check this a little bit. We're seeing some revenue growth, some slight growth kind of across the board. And so it would make sense, assuming that our receivable days are staying consistent, that we'd see a slight increase in our AR. So from 20 to 22 seems reasonable, all the way up to 32.2 in year 5. And so that seems to make sense. So that looks to be good. Next thing we'll look at is our inventory, and it's going to be incredibly similar, except instead of growing based off of receivable days, we'll do it off of inventory days. And so inventory days, very similar equation. All it's going to be is your inventory balance divided by your COGS, because that's the driver for our inventory. If we think about what would be the best driver, it's not going to be our revenue necessarily, but our inventory is going to be directly tied to our cost of goods sold. So in this case, we're going to divide it by our COGS, multiply by 365 to get our inventory days, and then the exact same thing to get our inventory balance. It's just going to be equal to these inventory days divided by 365 times our COGS. So it's the exact same thing with the slight twist of using COGS as opposed to revenue projected out. But first we'll calculate it here. So we'll take our inventory of 10 divided by our COGS. And I'm putting a negative sign here because I put my COGS in as negative up here. And I want a positive days amount for our inventory days. And then we'll multiply this by 365. That'll get us 7.3. So then we'll do this. We'll project it forward, assuming it'll stay the same. And then this will be straight lined inventory days. It's funny they ended up being the same, but that's just because the inventory was half of our AR, and then our COGS was half of our revenue, but typically they won't necessarily be the same. Then we'll take our inventory days, divide it by that 365, like we talked about before, and then we'll multiply it by our negative COGS, or multiply it by our COGS. But I'm just putting in a negative sign so it comes out as positive, and I can paste that forward, and there you go. All right, so now we've done our inventory, we've done our receivables, and we're on to our prepaid expenses. So the general rule of thumb is going to be for anything that does not have a direct driver, you're just going to assume that it will remain the same as a percentage of revenue. So for our accrued liabilities, deferred revenue, and our prepaid expenses, we're going to assume for all three of these that this is going to be a straight line. Straight line meaning being this, it's going to be the same percentage moving throughout the period. Straight line percentage of revenue. And so first things first, we'll calculate what is our prepaid expenses as a percentage of revenue. So we'll come up to our prepaid expenses of 10, divided by our revenue. And I'll throw in some formatting just so we can see. Paste down formatting from up above. All right, it's going to be 1% moving forward. I'll format it out. And so all we have to do to get this prepaid expense balance at the end of the year is we're going to take our prepaid expense as a percentage of revenue and multiply it by our revenue. So it will be 1% times 1100, which will be 11. This all looks to be good. There we go. Okay, perfect. Next thing is we'll have our property, plant, and equipment. And so we're going to come back to this. But remember, for our PP&E, it's going to be our beginning PP&E plus any CapEx less any DNA. So we need to get to our cash flow statement where we're going to calculate what our capital expenditure is going to be. Then we'll be able to bring this out. For goodwill and for a lot of long-term assets, you'll just assume that they'll remain unchanged throughout the duration of the period. So it'll stay flat at 20. I'll just put in a note here that we straight lined this. GHT. Oh. Okay. And now we can calculate or project forward our total asset balance. Okay, there we go. So we have our assets calculating. We still need to remember to go back and calculate our cash balance, which is going to be our beginning cash plus our net change in cash. And then also our property, plant, and equipment, which is our beginning PP&E plus any CapEx less DNA. Okay, now we can move on to our liabilities, starting with our accounts payable. This is going to be the exact same as our inventory in terms of how we're going to calculate it out. So payable days. So this is going to be our accounts payable divided by our COGS times 365. So it'll be 18.3. We'll assume that'll stay the same throughout the period. Then to calculate it, exact same way, we're just going to back into it. So our payable days divided by 365 times the negative cost of goods sold balance, or times our cost of goods sold, but I'm doing, remember, negative because I'm subtracting it up there and I want a positive number. 27.5 in year 1, and we'll project that out, paste that forward. For our last two working capital line items, we're going to do it, like I said, if there's no key driver, just do it as a percentage of revenue. So that's what we're going to do. So we'll do our accrued liabilities divided by our revenue to get it as a percentage, which in this case is going to be 1.5, and we'll assume that that'll stay the same throughout the period. Paste it forward. So to calculate it, all we're going to do is this percentage of revenue times our revenue, just like that. Same thing for our deferred revenue. We're going to do our $10 or 10 million in deferred revenue divided by our million, and then we'll format this just so we can see, and then it's going to stay the same throughout the period. Project it just like that. So for our deferred revenue, we'll do this, our percentage of revenue times our revenue, just like that. And then for our debt balance, you have the ability to do, and I'd be happy to do it in a later video if someone's interested, but you could put together schedules where you look at what your beginning balance is. You should take away any mandatory amortization or principal repayment, and you can kind of calculate the ending debt balance based off of pay down, and that's what you'll see typically in LBOs, and I have kind of other videos talking through that. But in this case, we're just going to assume that our debt balance is going to remain the same. Like I said, for a lot of the longer term assets and liabilities, if you have no reason to believe they're going to change or you have no real way to project them out, you'll assume that it'll stay the same throughout the duration of the period. Moving on now to talk about our equity component. For our common stock, we're going to assume no issuance throughout the period, so this will stay the same. And typically you can see potentially like common or the equity just be one line item of shareholders equity. You can see APIC or other things broken out here, but this is really basic. Just with common stock retained earnings. The one thing we will change is our retained earnings is going to be equal to our beginning retained earnings plus our net income less any dividends. Here we're not going to have any dividends that are going to be paid out, so it's just going to be our retained earnings plus our net income from up above. And so we'll paste forward our equity, and you'll notice when I paste over this check, there's a problem. We do not have the balance sheet balancing, but that's just because we haven't filled out our property, plant, and equipment and our cash balance yet because we need to do our cash flow statement. Now I'll paste over this to put up our cash flow statement. I'll just paste this from up above to format the year over, just like that. I'll copy the formatting. There we go. And now we're on our cash flow statement. Okay, so we're going to start with our cash flow from operations. We'll do like a subsection for this, bold it. Our line items here are going to be our net income plus our DNA, and then we're going to have our working capital. And so this is going to be everything that we projected up here. All of our short-term, all of our non-cash short-term assets, and all of our non-debt short-term liabilities. So I'll paste out, or wait, let me just do it like this. So we're going to have our AR, our inventory, and our prepaid expenses, and then we'll have our payables, our accounts payable, accrued liabilities, and deferred revenue. When we take into consideration all of this, this is going to be our cash flow from operations. Okay, I'll put a little border here so we can see it easier. We'll start off with our net income, which is easy. We're just going to be linking it from our income statement, and we'll only do this for like the forward projection. So in year 0, we won't have a filled out cash flow statement. But okay, starting with our net income, which was 168 in years 1. Then we're going to add back in our DNA from up here. So we're going to subtract the negative 55, which is going to add it back. So that'll be a positive 55 inflow in terms of cash, because if we remember, DNA is a non-cash expense. We have to add it back here. For our working capital line items, it's a little bit tricky, but not too hard if you remember the kind of basic rules. So for assets increasing, this is going to be a use of cash. For liabilities increasing, this is a source of cash. So we have to be careful with our signage and kind of what we're doing, but we can start working through. So we'll start with our accounts receivable. And if we see here, our AR is increasing from 20 to 22. And so what this would mean, if we're following our rule, is that an asset increasing is a use of cash. So the way that I'm going to project this is I'm going to take the previous year's balance of 22, or of 20, and then subtract out this year's balance of 21. And so I can see that that's a correctly equating a $2 use of cash from the change in net working capital from this AR line item. Similarly with inventory, we'll start with our 10. We'll subtract out the 11. That's increasing, which means that it should be a $1 use of cash, which we see right here. And then lastly, our prepaid expense, same thing, increasing, which is going to be a use of cash as well. Okay, so we did all of our short-term assets, our working capital asset line items. Now moving on to our working capital liabilities, it's flip-flop. So we'll see here that we have our accounts payable increasing by 2.5 million in year one. And so what I'm going to do is I'm going to take this year's balance less the previous year's balance to reflect that an increase should be a positive source of cash. And so here it's increasing by 2.5. And so what I'm going to do is subtract this year's balance from the previous year. So it's flip-flopped, and so that'll reflect as a source of cash, exactly as we want it to. I'll paste that over. Same thing with our accrued liabilities. It's going to be this year's balance less last year's balance. Paste that forward. And then lastly, we'll take our deferred revenue, this year's balance minus the previous year's balance. We can paste it out forward. Now we have the ability to calculate um, our now we also have our cash flow from operations, and so this is going to be our sum of all of our non-cash items plus our changes in net working capital. And so we can see it kind of reflected here. And so in this case, our cash flow from operations is going to be a positive 224 in year one, growing all the way to a positive 346.5. Now we'll move on to our cash flow from investing. And so you can have a couple of different line items here, especially if you have like the purchase or sale of securities. But in this model, this really basic one we're building out, our only line item is going to be capital expenditures, or we'll just call it CapEx. I think that's what we called it up above. And so our CapEx is just going to be a percentage of revenue. So we're going to have cash flow from investing. And so our CapEx, if we remember, if we scroll back up, we can see it's just going to be 10% of our revenue each year. So the way that we're going to calculate this out is by taking our CapEx in year one. We're going to scroll up to that percentage, which in this case is going to be negative 10. And we'll multiply it by our revenue of 1100. So that'll be 110. And our cash flow from investing is just going to be equal to this. So we'll have negative 110 growing all the way to negative 161 in year five. Our last section that we're going to have here is going to be our cash flow from financing. And so you can have a bunch of different things. You can have debt issuance, you can have dividends, you can have repurchases, you can have a lot. But we actually don't have anything that's going to fall under this just because we have no financing activities. So I'll paste in a few things, but we're just going to leave this blank, or we're going to zero these out. 0, and we'll paste it over. And so our cash flow from financing is going to be 0. And the last thing that we're going to have here is we're going to have a net change, our net change in cash during the period. Okay, here we go. So we're going to do this. And our net change in cash in period, just to be clear, is going to be our cash flow from operations plus our cash flow from investing plus our cash flow from financing. So we're going to do this plus this plus this. Okay, and I'm actually going to eliminate out this debt issuance just because I don't feel like building it into the model, but we can keep the dividends in and we'll go back through and change it. We'll change our retained earnings to calculate it. So we'll do that really quickly. So we'll go back to our retained earnings. Now that we did build in this dividends line, it's going to be our beginning retained earnings plus our net income less our dividends that are paid out, which are going to be 0 in this case. We can paste that forward just in case someone were to come back through and use the model. But we now have the ability to complete out our model and check to make sure they're balances. So starting with our cash balance, we'll do our beginning cash balance plus our net change in cash during the period. So that'll be 164. And I can unhighlight this now just because we've completed it. And then for our property, plant, and equipment, it's going to be plus our DNA. And I'm going to subtract out this negative, which is the same as adding it. And then we're going to subtract out our DNA. So we go to our DNA from down here, this 55 minus our DNA. We paste it forward. And if you can see at the bottom, our balance sheet balances. So at the very bottom, you can see that our check is showing that the balance sheet balances throughout the entire period. And so our model is essentially done. And so this is really just kind of a basic introduction to what three-statement modeling looks like. This is kind of the core that you can see, and obviously it can grow massively in complexity. You can have much more complicated revenue projections or projections for different income statement line items. You can also see some more complicated schedules associated with balance sheet items, like I spoke about, how you could have a debt schedule where you have a certain amount of your free cash flow being utilized to pay down debt, and that'll affect your interest expense. But this is really what we've built out here is kind of the core concepts that can then be extrapolated further on to get you to a full functioning three statement model. And so you can do a lot with this. This is could be the core of your kind of LBO and your free cash flow calculation. You could use this for a DCF, and you could pull your different kind of income statement line items alongside with your debt projection to calculate out some things. You could use this for benchmarking if you wanted to have your kind of income statement and utilize it to benchmark for comps analysis. But yeah, this is kind of the basic, income statement, balance sheet, and cash flow statement, and some of the key things that you're likely to see. And so I hope that this is helpful, and definitely feel free to take a chance at building it out. I'll show the assumptions one more time and let it sit just so you can see what it is, and feel free to come back and compare against my model if you'd like. Yeah, let me know if you have any questions. Bye.